When the stock market is up, everyone says, I wish I had bought during the last crash. But when the stock actually falls 10%, suddenly everyone's too scared to buy. The truth? Market downturns like the one we're experiencing right now have created more millionaires than almost any other market conditions. It's like a limited time sale on assets that have consistently grown in value over decades. What's up, everyone? Today, I'm breaking down exactly why this market dip is potentially a massive opportunity, especially if you're a 9-to-5 worker looking to build wealth. I'll share the data behind why buying during downturns has historically been so powerful, which indicators suggest that this could be a great entry point, and the exact strategy I'm personally using right now to buy high quality companies at a discounted price. The stock market is the only store where things go on sale. Everyone runs out screaming. When prices get ridiculously expensive, there's a line around the block to buy. We're going to flip that psychology today. By the end of this video, you'll have a clear framework for how to think about market dips and a specific action plan for taking advantage of this opportunity. So let's dive in. First, let's look at what history tells us about buying during market corrections. The S&P 500 has fallen 10% or more about once every 1 to 2 years on average. These aren't rare events. They're a normal part of market cycle. Here's what's fascinating. In the 12 months following a 10% correction, the market has returned on average of 15%. Over the subsequent 3 years, the average return jumps to 40%. Think back to March 2020, the COVID crash. Headlines were apocalyptic, the world was shutting down, and the stocks were in a free fall. Yet investors who bought during that period saw some of the strongest returns of their investing careers. What makes buying dips so powerful is the compounding effect. When you buy stocks at a 10% discount and they return to previous levels, you've immediately boosted your returns. When they go on to reach new high levels, that boost becomes even more significant. So what's happening right now in the market? The S&P 500 has pulled back about 10% from its highs, primarily due to policy uncertainty from the new administration, inflation concerns, and the reality of tariffs sinking in. The VIX, often called the fear index, has spiked, indicating heightened investor anxiety. Media headlines have turned decidedly negative, with recession fears dominating the conversation. But here's what's interesting. The fundamental economic picture remains relatively strong. Unemployment is still low, corporate earnings continue to grow, inflation has moderated from previous highs, consumer spending remains resilient. What's particularly telling is what the smart money is doing. According to MarketDash.io's institutional activity tracker, major financial institutions have significantly increased their buying during this dip, especially in leading technology and AI-related companies. It's like watching the casino owners suddenly start playing at their own tables. When the house starts betting, it might be worth paying attention. As billionaire investor Ron Barron recently noted, many leading stocks are trading at a 50% discount in valuation compared to just months ago, and market strategist Tom Lee believes this downturn is going to make millionaires for those who take advantage. So how am I personally approaching this market opportunity? Let me walk you through my exact strategy. First, I'm using dollar cost averaging rather than trying to time the exact bottom. While the market is down 10%, it could certainly fall further before recovering. I've divided my available cash into 4 portions: 25% invested at current levels, 25% ready if we drop another 5%, 25% ready if we drop another 10%, and I'll have 25% reserved for either a major crash or eventual recovery. This approach means I don't need to perfectly time the bottom. I'm systematically buying more as prices fall, lowering my average cost. Second, I'm focusing on high quality companies with strong balance sheets, consistent cash flow, competitive advantages, secular growth trends, reasonable valuations relative to growth. MarketDash's valuation dashboard helps identify stocks trading at discounts to their historical averages while maintaining strong fundamental metrics. For example, Nvidia has pulled back over 20% from its highs but maintains its dominant position in AI and data center markets. Its forward PE has dropped from 45 to around 22, essentially a 50% discount for a company still projected to grow at 30% annually. It's like finding a Ferrari selling for Toyota Corolla prices. Just because the dealership is having a bad month, the quality hasn't changed, just the price tag. Finally, I'm using this opportunity to rebalance towards sector likely to benefit from the current administration policies, such as defense, domestic manufacturing, and energy, all while maintaining core exposure to long-term growth, trends like AI and cloud computing. If you're working a regular job and don't have time to constantly monitor the market, here's how you can take advantage of this opportunity. Step 1. Assess your available cash. Determine how much you can comfortably invest without needing it for at least 3 to 5 years. Never invest emergency funds or money you'll need in the short term. Step 2. Set up automated investments. Most brokerages allow you to schedule regular investments. Consider increasing your 401k contributions or setting up automatic transfers to your brokerage account. Step 3. Focus on quality companies or ETFs. If you don't have time for extensive research, broad market ETFs like VOO, Vanguard S&P 500, or QQQ, NASDAQ 100 let you buy the entire market at a discount. Step 4. Stay patient and consistent. Market recoveries rarely happen overnight. The key is to stay consistent with your investment plan regardless of short-term volatility. Investing during downturns is like planting trees. The best time was 20 years ago. The second best time is today, and you probably won't fully appreciate the result until years later when you're sitting in the shade. Before we wrap up, let's cover the most common mistakes people make during market downturns. Mistake number 1. Waiting for the perfect bottom. Nobody can consistently time market bottoms. Focus on good companies at good prices rather than perfect timing. Mistake number 2, panic selling existing holdings. The worst thing you can do is sell quality companies at discounted price out of fear, only to buy back higher later. Mistake number 3, over-concentrating in speculative names. During downturns, focus on companies with strong fundamentals rather than speculative stocks that might never recover. Remember, the greatest wealth is created not by timing the market, but by time in the market, especially when you can buy quality assets at discounted prices. If you want help in identifying the best opportunities in this market, I partner with Market-IO to offer my viewers a special discount. Use code FIRSTMONTH for a free month of their premium plan, which includes all the tools I've shown you today. For those serious about taking advantage of this market opportunity, I'm also offering a limited number of free 15-minute strategy calls this week. Click the link in the description to book a time and we can discuss how to tailor this approach to your specific financial situation. If this video helped you see market downturns differently, please hit that like button and subscribe for more actionable investing content. Drop a comment with any questions or to share which stocks you're looking at during this dip. Thank you for watching, and I'll see you in the next one.